Hey y'all! Today is Sunday, December 24th. It's Christmas Eve, and it's also day 4 of our month-long Breaking into Wall Street challenge by learning about finance and investing and posting about it every single day. So today we are talking about valuation. Valuations, we need to understand, is like the core and the crux, the center of everything when it comes to investment banking, but also just finance and investing in general. Why? You need to know how much a company is worth in order to proceed with like an M&A transaction or like an LBO deal, right? So anything to do with private equity, investment banking in general, you need to know how much the company is worth. The question is, how does one value a company? Well, there's two ways, right? The first way is a relative valuation, and the second way is an intrinsic valuation. So what are each of those, like, and what do those mean, right? So when it comes to a relative valuation, you have two ways of going about this. The first way is basically comparing it to what other companies are looking like within the industry. So the first way is looking at public comparable companies. So that's to say you want to compare a similar industry, maybe a similar time frame, maybe a similar transaction size, whatever it is, you're comparing it to a similar company to get a general grasp of what your company is worth. So step one is a comparable company, is comparing it to a comparable company. Strategy number two when it comes to relative valuation is looking at other merger and acquisition or M&A deals that are simultaneously happening, and this way we call it precedent, right? You're looking at a private company, or you're looking at just any sort of merger acquisition deal that is being closed, so that you can get a good idea of what your value is worth in the industry, because those are the general gist of what other companies are being sold for, so you can get an idea. Now, the second way you can go about this, intrinsic valuation, looking at the intrinsic, or like the true nature or the true value, by estimating the net present value of all future cash flows. So this is where and I'll be talking about this as I study DCFs later with you guys, but an intrinsic value looks at the net present value because there's a time value of money principle. So what does the time value of money principle mean? It means that like $1 today is worth more than $1 tomorrow. Why? Because you can take that dollar today and invest it or buy a government bond or whatever and earn some kind of return or interest on it. So we just know that money today is better than money tomorrow, which is why we need to discount that money back to find the net present value. And so we want to look at the cash flows, right? We use a DCF model. Quick side note that this format is some kind of a variation of an assets minus liabilities equation to find out like the intrinsic value, or what we call book value. So the question then is like, okay, if those are the strategies that you use, when should you use which strategy, right? So we know that like relative valuations are almost religiously used because public companies and comparisons to those companies, as well as precedent transactions, draw parallels between your company, right? So like there's a lot of other factors in the industry that play into it. So something isn't just going to be worth like the net book value, which is why we need to consider how much is like a strategic buyer willing to pay for your company, which is why we use relative values, right? So if you think about like that housing market, it might not necessarily be something you're willing to pay for, but it's something that the market is selling, or something that the market is selling is a lot lower than something that you'd be willing to pay for. Like how do you specifically pinpoint a price to a geographical location of a house, right? Then note that a DCF analysis, or discounted cash flow analysis, should be used in standard industries like tech, healthcare, or retail, because those are fairly predictable, right? We want to use predictable industries or predictable companies because it's easier to base our assumptions for the discounted cash flow model. So if an industry is like asset centric, then cash flows don't really matter, and assets and liabilities play a bigger role within that company because we should use that to evaluate. So for example, if you think about like a chartered bank, right? They buy a bunch of government bonds, they buy a bunch of like securities and stuff. So that's to say that that industry doesn't really care about the cash flows and how much free cash you have at any time. Or for example, like real estate industry or the oil industry, right? You're more focused on obtaining more assets as opposed to obtaining more cash for like day-to-day operations. That's why we should use something like an asset liability model as opposed to looking at just the cash flows. So TLDR, Discounted cash flows is good for mature companies that are predictable, unlike startups, because they're very, very volatile and it's hard to predict future projections because they could fail at any moment in time. And precedent transactions work a lot better with companies that have a lot of market data and aren't very foggy, right? So like, for example, if a private company doesn't have a lot of data, then you're not going to be able to base a lot of like empirical hard evidence on that. So the question then is like, okay, if we've decided which strategy we're using, right, and we've also looked at why it's beneficial, then which company should I pick to compare that to, right? So let's say we are choosing to work with a comparable company, then which company, right? So there's a few factors that play into this. We should look at number 1, geography, number 2, industry, and number 3, similar financials. Right, you don't want to compare a very, very small bank to a very, very big chartered bank because they just process so many more transactions. You don't want to compare, for example, McDonald's to a retail clothing brand, right? Because they work in vastly different industries, and so it's hard to compare the same level of cash flows or data or some kind of valuation. You also don't want to compare companies that are in completely different geographical areas, right? If there's like a higher tax rate in a specific state versus if there's a lower tax rate in a specific state, then it's not easy to compare these, right? So look at geography, look at industry, and look at similar financials, whether that be it their revenue, their EBIT, their net income, whatever that is, right? Now, when it comes to looking at precedents, we also need to consider time, because as time goes on, business cycles happen, the market changes, a lot of factors do influence the market. So we have to consider how long has it been since this transaction has occurred, because markets do shift as time goes on, right? So if I'm choosing to base my transaction off of like an M&A deal that was closed in 1990, that's going to be very, very different than how much somebody is willing to pay in today's time, right? So the question then is, now that we've answered which company to pick, what metrics should we be using to compare on, right? So there's a few things. There's EBIT, there's EBITDA or EBITDA, however you pronounce that. There's the PE ratio, there's the equity value or the levered free cash flows or enterprise value, or also known as the unlevered free cash flows. So let's look at like which metric is strong for which areas. So note that EBIT is good for companies who have capital expenditures to factor in, and it's crucial to do so. So this depicts the company value relative to their operational income. On the other hand, EBITDA is good for companies where capital expenditure and amortization is less important. So this depicts company value to operational cash flow as opposed to operational income. Now for the PE ratio or price to earnings ratio, it's good for things like banks and financial institutions because it does depict the overall strength of the economy since it's affected and distorted by tax rates, capital structure, etc., right? We want to measure company value relative to net earnings because there's so many other factors that do play into something like a chartered bank. Now for equity value or levered FCF or free cash flows, we don't commonly use this because it has a lot of volatility based on capital structure, which is basically the debt to equity ratio, but this is the strongest depiction of a true cash flow. Again, we don't want to use it for a company that doesn't need cash flows for, say, as much as opposed to their assets. Now for enterprise value or unlevered FCF, this is useful for when capital expenditure or current assets and liabilities are hugely impactful, right? We want to look at the operational assets, the operational liabilities. So this is strong for comparing different companies in different industries, right? So when we're comparing that, we can then look at like their cash flows instead of comparing like different specific metrics, right? So the reason why this works so well is because it's capital structure neutral, and we don't really care about how something is financed. We don't care whether it comes from debt or equity. Now, a few more things to go through. The next thing is a book value multiple, right? So we refer to book value as BV. Book value multiple is either EV divided by BV, so equity value. Yeah. So a book value multiple is EV over BV, or equity value divided by book value. You can also calculate it by price per share divided by book value per share. And what this is really asking is how valuable is the company revenue relative to the balance sheet, right? What this is depicting is basically how the question that book value multiples basically asks is this is basically asking you how valuable is the company relative to the balance sheet. Now, we want to also note that this has become less relevant over time since companies have started to shift towards going into a service industry and intellectual property oriented, so we don't actually care as much about the book value, right? The book value is basically how much assets do you have per dollar of liability, or like you can just find out the net assets that you have, right? So we don't really care about assets as much anymore because we're providing services or we have a lot of patents on intellectual property, so it doesn't matter as much as before. Now, speaking of book value multiples, what is a multiple? Well, a multiple is a relative measurement of one metric in a company's financial health in terms of a different metric. So what is the link between a metric and a multiple? Well, relevant multiples and growth rates tend to have some kind of a correlation. So for example, higher revenue growth tends to have higher revenue multiples with all other factors ceteris paribus, or all other factors remaining the same. The same thing applies to higher EBITDA growth trends tends to lead to have higher EBITDA multiples than companies who are growing at a slower pace, right? You can draw a lot of these parallels because generally speaking, the growth rates have some kind of a correlation with a relevant multiple. The last thing we need to cover is, what is valuation really like in the real world? Well, the purpose of a valuation, right, is to associate the price to a company. So that means that you can use this valuation to reaffirm or to challenge an acquisition offer, be it for private equity or like an IPO or whatever. You're valuing the company so that you can challenge or reaffirm the current price that's being given so that you can make a better deal or make a deal that's more in favor, right? There also might be premiums or discounts based on factors outside of their financial statements. So that's to say that not everything is what's listed on paper, right? So for example, there's legal rules or there's business cycles or a lot of other factors outside of the financial statements. So like, for example, if you're owning versus leasing a building, that impacts your EBITDA greatly, because if you own versus if you lease something, you're going to have to pay rent, right? And the rent expense does factor in over time. So just note that there's a lot of factors that impact valuations, and it's important to consider what the most appropriate valuation for each individual circumstance is. Cool. That's it for day 4. I wanted to keep it really, really short, but understand that valuations is a super, super important concept in financial literacy, in investment banking, just finance in general. So make sure to study it well. Cool. Thank you so much for watching, and I'm really glad that you made it to day 4. Hope to see you in day 5 strong, holding each other accountable. Peace.